Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are here as we talk about financial matters. Both myself and my co-host, we are both financial planners, investment advisors. We spend our weekdays helping people like yourself plan their future, and we are broadcast on the weekends to do this program to help be your financial advisors on the air. And so whether you have advisors you're working with now, or you enjoy listening to this because you do things on your own, or you want a second opinion, or whatever the case may be. Anyway, we're glad you are here.
And I'm glad I'm here. As a
this planet.
As a result of the COVID, our office is
ghost town.
People work remotely, and so Scott and I tape this show. So if you call in today, right now, you call in, they're going to schedule a time for you to be a guest on our show. That's how it works. So we come in during the week. But we have a radio and television studio in our office. Nothing fancy.
And by the way, we did it live for 20 plus years.
Every weekend.
And after some point in time, it's like...
So we have this radio and television. Like I said, nothing fancy. Right? It's just a room that's soundproof. It's the only time I ever come to the office to do the radio show. And I really miss going to the office.
But the problem is you go to the office, it's not the office. There's no one there.
There's no one here.
So it's not. I can't interact with the rest of the team.
Yeah, that's right.
Because they're not here.
Yeah. I mean, I can't. I ran into a coworker at a barbershop. I'm going to tell you, had my mask on, completely covered, go to the barbershop, run into a coworker. I hadn't seen him in 3 months. Like, it's nice seeing you. It's a strange world, isn't it? And you look at these big companies.
I ran into your barber this last week.
Oh, Barber John?
Yes. I had a nice chat with him.
Did you?
But I don't get my hair cut there anymore. I feel kind of bad. But
anyway, his wife, Michelle, is a huge fan of the show. He has asked me.
He asked to take a picture. He took a picture with me and with the two of us together.
He asked me to mention Michelle's name for her birthday.
When's her birthday?
I don't know.
Oh, happy birthday, Michelle.
Well, it was a while ago.
It's within the next 12 months. It's in the next 6 months.
Anyway.
Either side.
My point being, though, it's nice coming into the office and just...
And it's so strange the economic impact this has on various people. I went into a tailor shop this week. I'm short. And I know better than to buy online, but I can't... So I bought some pants online. They've been hanging in my closet for 2 months because they're too long.
When did you get some?
2 months they've been hanging there, and
you bought clothes online.
Yeah,
pants.
But I had the
like
brand.
Hager double knit. Are they reversible? Did you buy them in the back of Parade magazine?
My point is, so I went to the tailor. And I hadn't been in there in years, actually. But he's a nice guy. He's an immigrant from Afghanistan. He's a very interesting guy.
Next to Barber John's.
Yes, and both his kids, one's at UCLA, one's at UC Santa Cruz.
What a great story.
I love talking to him. I love talking to guys like this.
What a great story.
And I was just saying, how's business? I can't imagine it being good when everyone's working remotely. He says what really killed him, he says it's all the events. The proms, the weddings, all those dances. He says, I don't make any money on him and pants. He says, that just pays the bills. All my profit comes from these special events, particularly doing the intricate dresses.
Who would have imagined?
So he says, I'm not making any money at all. Not making a dime.
Who would have imagined?
Yep. Just bizarre. Anyway, we got a lot of good stuff to talk about today. We'll take some calls also.
But Scott, California is not the U.S. California is not the U.S. There are states that are not.
I'm going to be very transparent here.
Okay.
I watched the Super Bowl last weekend in Florida. I live in California. And I'm thinking, why is it that we can have a Super Bowl where thousands of people show up in the stands, knowing there's going to be parties afterwards? First of all, there's athletes all playing. That's okay.
But you can't.
I can't go out can't take my wife out to Valentine's dinner.
Or church.
Well, you can go to church now.
Yeah, well, because of the Supreme Court.
Because of the Supreme Court. Up until this weekend, it was illegal to go to church.
Right.
But you can have a Super Bowl in another state.
But we can't talk about it because it's very political.
That's true.
I mean, that's just the reality. The whole thing has been weaponized.
How is it became so political?
It's political. I don't know. Anyway,
we
you know
don't
what I do want to talk
that.
about, Scott? I want to talk about this SPACs.
Oh, gosh.
SPACs. That's what I want to talk about, which is special purpose acquisition. But
last week we talked about. Last week we were talking about the program on Bitcoin, Tesla owning Bitcoin, Reddit, GameStop, Robinhood, all those kind of crazy days.
This is just a different flavor.
It's the same kind of bizarre thing.
Well, let's take some calls, and then we're going to come back, and we're going to talk about this.
SPAC, special acquisition company.
Special purpose acquisition companies, and the boom that is taking place in these things.
I feel like I'm witnessing a transfer of wealth from middle-class savers to sophisticated investors.
It's brilliant.
Isn't that what it feels like?
Oh, Scott, I don't agree with how they work, but those guys that are launching these things, that's exactly what they're doing. But let's talk. All
right. To be part of our program, 833-99-WORTH will get you on the show. Again, 833-99-WORTH. That number numerically is 833-999-6784. And let's start off here in Colorado, talking with Chris. Chris, you're with Allworth's Money Matters.
Hi. Thanks for having me.
Hi, Chris.
Hi. So I had a question for you guys. By the way, I really enjoy your show. I
Thank
listen
you.
to it when I'm exercising on Saturday morning.
Oh, good.
You do what?
Yeah.
When do you listen to it?
She's exercising.
Oh, isn't that? I love
yeah.
listening to podcasts when I exercise, when I bike ride.
Oh, yeah.
Absolutely
it's so
love
much
it.
fun. But I always learn something from you guys, so
good.
I'm really excited to be on here.
Oh, good.
So here's my question. You know, I listen to a lot of people that call in, and a lot of them are in way better financial shape than I am. I hear about their big pensions they're going to get and how much money they have saved, and we're not doing too bad. But I just wanted to ask your advice on pretty much all of our money is in retirement accounts.
Okay.
And we probably have, I'm 50, almost 57, and my husband is 1 year younger. And we have about 1.1 between all of our retirement accounts.
Okay.
And our goal would be, we've always talked about this because
By the
we
way,
both
Chris.
have parents.
By the way, Chris. If
Yeah.
you look at the majority of Americans at 57 and 56, nowhere close.
Nowhere
As a matter
close.
of fact, I think the average 401k balance is under $200,000.
Yeah.
So
You're doing great.
Yeah, I feel good about it because
there's always someone with more.
Yeah, there is. But we're definitely middle class, and so I feel good about the fact that we've really socked down and saved.
It's not easy
But
accumulating
so I'm
that
kind of
amount of money.
nervous. Oh, I'm sorry. What was that?
Oh, wait.
It's not easy to accumulate that much money. It takes sacrifice.
I know.
Yeah.
I know it does. But so anyway, I'm a little nervous just because the stock markets are so high right now, and I just wanted to ask your advice on maybe. Right now, we've been somewhat aggressive. We have I looked over all of our accounts. We probably have about 75% in stocks and maybe only about 25% in bonds and other. If we're wanting to retire, we want to retire a little earlier just because we both have parents that had poor health young and we want to enjoy life.
Mm-hmm.
And so maybe in 6 to 7 years, are we being too aggressive there?
Have you?
Well,
what was your allocation a year ago?
The same.
How about
Same.
3 years ago?
I
mean, have you rebalanced this?
It was even higher. Yeah, I do. We probably had even a lot more in stock, probably closer to 90%.
And tell me what your debt looks like.
We only have just our home, and we owe about maybe $120,000 on it.
And what's the value of the home?
Probably about $450,000.
And what's the interest rate?
We just refinanced, so I think it's 2.7 or something.
Oh, you
like
are
that.
poster. You are such.
And we did 20 years because we actually made that bad decision when you're young. We refinanced a couple of times and took cash out and did 30 years again. And we would have almost had it paid off by now if we hadn't done that.
And
whatever.
You do a great job.
And
I don't think your allocation is too aggressive.
So think about the investments are based on two things primarily. One is time horizon. how long you have before you need the dollars. And the second is your tolerance for risk, your ability to withstand the ups and downs in the market. And what we know historically, over long periods of time, owning those companies that produce things, owning the large companies in the United States, the smaller companies in the United States, owning stocks have produced a return much higher than just about any other asset class. Broadly diversified, done about 6 percentage points above that of inflation over the long period of time. Over the short period of time, it's anyone's guess. Matter of fact, historically, about 1 out of every 3 years, the market finishes negative. About 1 out of every 3 years.
I guess I remember how devastated we were, and I think it was like '08 or whatever.
And what did you do?
We lost so much money. And
what did you do?
I thought, oh my gosh. Well, I was stupid. I kind of panicked a little bit and went more conservative.
Okay,
and then, of course,
all right.
when everything rebounded, then I didn't get the gain.
That's right.
So I didn't panic in 2020. So that was good. I left it alone.
I'm gonna restate. I said earlier that you were good. I'm gonna change. I'm gonna change. Here's what I would do. If you were
I want you to think,
Chris, if you were my little sister, this is what I would tell you. I would amortize that mortgage over the next 7 years and pay it down so the day you retire, the home is paid off.
assuming you're going to stay in that house or that area.
Right? So that's number one. So I forget what the length of the mortgage is. I would just go to a financial calculator, put in my remaining balance, and figure out what the monthly payments will be so that the day I retire, the home is paid off. And the second thing I would do is I'd rebalance this portfolio to go 65% stock, 35% bonds and cash. I'd visit it twice a year to make sure those allocations were correct.
And maybe have all of your new deposits go into 100% stock.
Fair enough. But I would move it down to 65, 35.
But it's helpful to think about it like this, too. Let's say you retire in 6 or 7 years. You're not going to spend this $1 million your first year in retirement.
You're not. In fact, that 35% that you have in bonds will allow you to take withdrawals regardless of where the market conditions are in the equities.
You could go 10 to 15 years before touching stocks, which is, matter of fact, there's never been a 15-year period of time where stocks have not outperformed bonds. And in an interest rate where bonds are almost nothing.
And the rest of it's emotional. And you know that how you reacted in 2008 was emotional.
But when your accounts are mixed, like a 401k with a bunch of different things, and you make withdrawals, you can't. Can you choose which fund you're withdrawing?
You can, but also, but by just doing a simple rebalance each time, it accomplishes the same.
But no, you absolutely can. I mean, you absolutely can. In fact, when you retire, you're going to actually move that money out of a 401k into an IRA, and you have even more flexibility. So the idea of leaving money in a 401k is it's antiquated.
Well, it's an easy approach.
You wouldn't do it.
Of course not.
Right?
But if someone is an unsophisticated investor, has no one to trust, it's not a large account, that's why.
But Chris is bright.
I understand that.
I mean, the mere fact that she knew her allocations is impressive.
And you learned a lot through the financial crisis.
Oh, yeah, I really did. And that's why I didn't touch it in 2020. And I'm so glad because I had all kinds of people telling me,
it was hard.
You got to move to cash.
But you think about this,
don't listen to them.
These right? Interest rates right now are, how much do you earn in the bank right now?
What was that?
How much do you earn on your money that's in the bank right now?
Not even 2%.
Okay, correct. Nothing, right? Those returns you received last year is because you own stocks. And the cost that there's a cost. There's no such thing as a free lunch in anything in life, right? So the cost for that is for you having to withstand and endure the ups and downs of the portfolio. That truly is the cost.
So when you excess returns over cash, the cost is risk.
And that risk, if you are diversified, the risk is really a short-term decline. They always have been short-term decline. But if you think about it, like, wait a minute. That's right. This is what I'm paying for those extra returns. This level of uncomfort I have to deal with, that's the cost I have to pay to get the excess returns. If you can view it that way, then the next time there's a downturn, you won't have the same reaction. You'll say, wait a minute, I've lived through this before. I realize that these are temporary. It's going to look different next time. It's going to be ugly. Who knows when it'll come, but it'll come. It's going to look ugly. Your friends are going to tell you, Chris, you're crazy. You're so close to retirement. Why are you betting your retirement? We pulled our money out last week. You're foolish. You'll hear all those things.
You know, Chris, on a personal note, when the markets tanked last time, I increased my equity exposure significantly.
Well, all of our clients did because it's through our rebalance process.
Understand. But where I would normally be 60% stock and in my own portfolio, 70.
I can't say all, but anyway.
70 to 30. I have no emotional attachment to my own portfolio whatsoever. I just don't. It doesn't bother me when it goes down, and I don't get excited when it goes up. It's just, but the last decline and in the last economic crisis, at the same thing. I just this is the greatest time in the world to buy.
Yeah, I actually did that. Because I was one of the ones lucky enough to have my job all last year, so I actually increased and just was buying in my 401k.
Brilliant.
I figured this is the time, right?
Thank you. Brilliant.
It'll eventually go back up, but
maybe I changed my mind again. I think you might be 75-25 for the long term. Seriously,
I gotta get more brave, I guess.
It's
It's
all
a
based.
life lesson I learned the hard way for sure.
Right.
That's good, though.
That's good.
Better
right?
to learn it now than when you were 42 as opposed to 57.
Yeah. But the only thing I would do is keep it between 65 and 75% stock.
And think about how much money that is outside of the stock market, right? Make sure you're fairly conservative in those things. And then when the markets are falling, and they will, I don't know if it's this year, next year, who knows, right? But look, considering the last 20 years, we had 2 declines of roughly 50%. If I were planning my retirement over the next 20 years, I would plan there's probably going to be a couple of declines of close to 50%.
Would you worry about it?
No, I wouldn't worry about it.
Why?
Because there's nothing I can do. That's just the reality. And I know that timing the market doesn't work. There's no, if we could say, look, now's the time to get out, now's the time to get in, that would be fantastic. But nobody can do that successfully over the long period of time. They might get lucky once or twice.
As was evidenced by 2020 when the markets went on an absolute tear, fastest bear market in
The shortest, the quickest recovery ever.
ever. And
I
if
was
you,
shocked.
yeah,
We were
right?
all shocked. I'm in the industry and I was shocked.
I was having a conversation with a friend 2 days ago. I said, I don't understand how this stock market is doing as well as it's doing. And he said, well, this is what you do for a living, Pat. I'm like, yeah.
Well, you do understand because you understand what drives it's human emotion.
That's right.
It's behavior. It's herd mentality. All those things are what drive prices short term.
I don't understand how it's doing so well when the fundamentals aren't there.
If one thing that shows you that fundamentals and prices are totally irrelevant to one
Do you guys
another
think
over
there's
short
going
term.
to be a big crash?
Oh,
Oh,
sure.
I know it. Absolutely know it. But I don't.
I believe it.
That's look.
But I believe the best way to go through that is not to try to time it. It's to have your long-term investments ride through the storm.
But Chris, the question isn't do we believe it's going to happen, because we believe it's going to happen. The question you should be
When?
asking is when.
Yeah.
And I have no idea. Not a
Yeah.
clue.
Well, you
Couldn't
shouldn't be
even guess.
asking. It doesn't matter. If your portfolio is set up in such a manner, you've got the discipline going in, you rebalance periodically.
How many times did we rebalance our portfolios?
3 or
Last
4. All of our qualified accounts.
Everything in IRAs, which means
Well, in the vast majority, there might be some outliers, so I don't want to put.
Okay. So what that means is that you know how you look at your portfolio and you measured your stock to bond ratios,
Yeah.
right? We rebalanced our portfolios 3 to 4 times last year.
In February, because the markets had run up and our stock exposure got too high, not because we thought the downturn was coming. It was just the fact that, look, if someone was supposed to be 60% in stock, their portfolio drifted to the point where they're 64 or 5 or whatever the number was. We sold off some stock, and it wasn't because we were predicting the peak. It was just that now we had a higher percentage than we want. Then was
We
the
had
plan.
a discipline going in.
Then the market had this tremendous sell-off so quickly, we did another rebalance like 3 weeks later where we bought more stock. Not because we saw the bottom coming or we knew that this was the bottom. It was just now that we had less than 60% because the market's full. So we sold off some bonds, bought some more stocks, and just that process of a rebalance.
It did well. It was, it was great. But you should have the same discipline if you're managing your own money. And I think you have the ability. So quite frankly, you should run your portfolio through a screen 4 times a year.
Okay.
A minimum of twice. Minimum of twice.
And I think over the next 20 years, you'd be better off sticking in 75% stock.
That's right.
But you have to realize that You're going to see some bigger swings in that account, and it could be next week. Nobody knows. And I would anticipate a 50% decline in stock values.
At some point in time.
Just because we had it twice the last 20 years. Why wouldn't you anticipate
by the way,
it
Chris, you've done a great job with your savings.
Yeah.
You should be proud of
feel
yourself.
good about yourself.
You should go back to your husband right now and just say, I'm a stud. I did a great job.
Yes.
I know he said, I told him I was going to be on your show. He's like, oh, I'm going to have to get your autograph after.
Right?
Yeah,
I'm glad
good job.
And,
Yeah.
and I am the saver. He's great about just letting me handle it, because even with his, I get on and I just increased his to like 17%. You know, I'm always trying to.
Oh, good.
You know, he would spend it all if he could, but he
But we do like
appreciates
to
that I'm the
Pat's
saver,
point. Well, good. You probably balance each other out. He helps you have a little fun sometimes. To Pat's point, if you can swing it to where you get the house paid off by the time you retire,
brilliant.
even if you took slightly less deposit in your 401k to get it done,
exactly.
it's just you need less money in retirement.
That's right. Money
easier.
not going out in retirement is exactly the same as money coming in. And having no mortgage
true.
at the house.
That's great advice.
Well, thank you.
And then I don't know. Do I have time for one more segment?
Go ahead.
Sure.
Yeah.
So my husband does have a pension because he works at a large hospital system in the Denver area that he would get. And it's nothing next to the pensions I've heard people talking about on your show. But I guess I'm a little nervous because I wonder, is there any chance that could go away?
Yes.
I mean, if it's a reputable company, is it
We
most likely
said yes,
something we
I
can
said
count
no.
on?
No. It's guaranteed by the PBGC, which is the Pension Benefit Guarantee Corporation.
Yeah.
The smaller the pension, the bigger the guarantee
That's right.
is.
So I would not worry about it.
Can it happen? Yes, it can happen.
Statistical chance.
There is. It can happen.
The statistical chance of if the company went bankrupt, the Pension Benefit Guarantee Corporation took over the obligation for them not being able to make the benefits. What's
My
the
own
chance of that?
father worked at Levitt's Furniture. You remember You'll Love It at Levitt's. His check in retirement came from the Pension Benefit Guarantee Corporation. The company was insolvent.
Does Levitt's no longer exist?
I don't.
You love it at Levitt's.
I don't know. All I remember is we could get furniture at cost. That was the best thing about my dad's job at Levitt's. But his check came from the Pension Benefit Guarantee Corporation. The smaller the pension, the older your husband is when he retires, the bigger the guarantees. But these airline pilots that were forced into retirement at age 60 that worked for United and American, they had substantial decreases in their pensions.
It's similar. Think about it like the FDIC insurance on bank accounts.
So if his pension's less than, let's say, $2,000 a month, I wouldn't worry about it.
Nope. I'd have no worry.
Yeah. Well, that's good. And Social Security is a whole other story. We probably can't really count on that.
Yeah, now you'll be fine. You'll be fine. You're 57. The benefits of Social Security, the day you should worry is when they stop sending checks to people that make over $100,000 a year. And that will happen. There will be a time where they...
At some level.
It needs-based Social Security.
I don't know how else we navigate through it.
Yeah.
There's only so much you can tax young workers.
So I appreciate the call.
Yeah.
Thanks, guys.
Good
I
luck,
really
Chris.
appreciate it. Bye.
Yeah, thanks, Chris.
Yeah, it's like poster child for kind of financial planning.
Well, so think about this. The Affordable Care Act, right? You're like...
What about it?
You can, regardless of your net worth, if you retire, you leave the workforce, you no longer have insurance through your employer. If you have money in Roth and non-qualified money and a little bit of money out of IRAs, you can temporarily, on paper, look like you're impoverished. So I
had a friend of mine when I was on Obamacare. He took he had an early retirement offer from his company. It wasn't retirement. It was because he really didn't have a pension. It was a severance. Like, we'll pay you a year or two or whatever, whatever the number was. He wanted a little bit of a sabbatical. He took a year off. And he was mid-40s or so. Wife, 2 kids. Wife stayed home. Actually, wife had very serious medical expenses, medical conditions. And he has ample savings, many rental homes.
High net worth.
Correct. A couple million bucks probably. I don't know exactly.
But he artificially impoverished himself.
He didn't artificially. It was all based upon his taxable income. His taxable income was very low. So he qualified for Obamacare.
He had income. It's just the taxable income.
He had plenty of assets.
Yes.
So
in a normal world, you would look at that and say,
does he need subsidized medical insurance?
Yeah.
This is the United States of America. It's not a normal world.
Right?
Congress creates these laws.
Yeah.
There's all kinds of.
And a good advisor, look, how do I feel about morally? I don't know how I feel about morally helping these clients. But that's, they gave us the rules.
Congress look, every time they pass a new law, our job is to help our clients figure out what's the best path for them personally.
Yes.
Of course.
That's right.
We're all humans.
Right.
Yeah.
Yeah.
Anyway.
What's good for the individual isn't necessarily good for the whole.
Anyway, we're going to take some more calls when we come back. We'll also talk about SPACs. This is Allworth's Money Matters.
Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McLean would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean.
Yeah, let's go right to the calls. Talk with Joanna. Joanna, you're with Allworth's Money Matters.
Good morning, gentlemen. How are you?
We're good. How are you, Joanna?
Good. Let's see. I have a question in regards to purchasing service credit. I work for the state of California. And so I have 4 years of service credit that's available to me to purchase.
Understand this. You left the workforce at some point in time and cashed that in. Is that why it is available to purchase?
It's available from my military.
Okay,
Got
thank
it.
you. Bridge. It's bridge service. Okay, perfect. Thank you. All right, the question? I know what the answer is going to
I
be.
do too, but go ahead. With
But
the
ask the question.
Oh, okay. Well, my question was just, is this something that I should be looking into?
Buy as much as you possibly can.
And if you don't want to do it with your money, I'd love to do it with my money. Let's work out some sort of deal.
All day long.
Okay.
It's that good of a deal.
It is unbelievable. It is
Really?
the highest rate of return you will ever get on your money. And when it was available, they used to be able to buy 5 years of service time.
And this is for the state of California's
State
plan.
of
I'm not going to
California.
state for other.
But if you work at a municipality or a government where they offer you what's called service credit that you could purchase, or in this particular situation, it's bridged for Joanna, the unbelievable rates of return. So now,
I mean, kind of like
Really?
8% with the guaranteed cost of living
yeah,
adjustment.
and the reason is because the formulas for your pension are based on years of service and age. And if you look at the grid, the further you get up into the right, it accelerates really, really fast. So anything you could add to that actually helps you. Now, the second question is, what money do I use to purchase this, right?
Exactly.
Where is do you have money in a 401k now or a 457?
Yes, I do.
How much?
Total, I'd say about 38.
All right. And what's the cost of the bridged years, 4 years credit?
It is 44,868.
Okay. And so do you have any money outside of the 457 that you could use?
I have a separate account through Allworth and Fidelity.
And how much is there?
I'd say about 60,000 or so.
Perfect.
And and how's it in, it's not in an IRA, it's in a brokerage account, correct? It's outside of an IRA or it's inside an IRA?
It is I think it's a traditional, and then I have a Roth IRA.
Okay. So you could pay for it two ways. Scott, do you have an opinion on this? I'm thinking that she just takes it out of her paycheck to do it.
Yeah, how much is it if you take it out of your paycheck?
A month.
It depends on definitely the month. So if I were to do it for, it says for even here, 15 years.
How old are
it'd
you?
be almost 44.
Yeah. And have you bought it over 15 years? What would that cost you?
It would be about 400.
And what's the cost of money on that? Do you know? Is it 3% or 2%? So there's a.
Yeah.
So
it
what
says
happens?
It says 7% interest.
Okay.
then
All right.
we don't want to buy it over time.
We don't want to buy it over time. You're going to use the money at Fidelity, the money in the IRA, or
If you have an account, it's what, 44,000 you said?
Yes.
If you have one account that's $44,000 or slightly higher, I'd use that account.
That's right.
Just to make it simple.
Yep.
I would definitely
Okay.
buy this.
Yeah, and I wouldn't buy
Joanna,
it over time.
I feel so
wow.
strong. So at Allworth, we manage close to $11 billion for our clients. If I could take that $11 billion and run it through your scheme, we would have every penny invested in these.
Every
pension-
dime. When this was
Oh, wow,
available
okay.
years ago to our clients, I used to call it
Because
an
it used to be you
IQ
could
test.
just buy extra 5 years.
5 years.
An additional 5 years. You didn't need to bridge service or have a gap in service. You can buy an extra 5 years.
Yeah, and we did it.
I had
assuming the
arguments with many
clients-
clients like, trust me, I want you to take the money away from me and put it there. You're going to earn more there.
Assuming they had a normal life expectancy.
Yes.
Okay.
All right, so do it. Use the money in the IRA, and if you need any help, just call our office, and we'll have someone walk through which
Yep.
account to use. And you'll just email
That's
over
great.
the accounts, and then they'll tell you exactly which ones to use. All righty?
Perfect.
All right.
Thank you so
Yeah.
much,
All
Jeff.
right. And thanks for your
you called.
service.
Yeah. Yes, thank you for that too.
Thank you. Thank you.
And I feel good about helping people, particularly with the military service.
Yeah. It's,
But to your point, our job is to help people. Whatever the rules are in front of us.
you play them.
I remember I had a friend who said, "Well, those rich, they take advantage of all these loopholes." I said, "Don't you itemize deduction on your time? Don't you look for everything you could deduct as well?" I mean,
Wouldn't
I don't know if they're loop.
First of all, look, you don't take the long way home from work. You don't get in your car and say, my house is 10 miles down.
Unless you're in a fight with your spouse.
My house is 10 miles that direction, but I'm going to drive around the city first and then get
So you
home.
get the courage to come home.
Is everything okay in there?
It is. Oh, it is today. We've all had those days, have we not?
Yeah.
All right, let's continue on with some calls here. 833.
My wife and I celebrated in January 35 years.
Wow, good for you.
Yeah. Pretty amazing. She likes to say 28 of them happily.
Yeah, well,
It's pretty good.
that's probably real.
It's
I mean, come on.
A B student. I mean, that's all I was.
833-99 Worth to be part of Allworth's Money Matters. Let's talk with Paul. Paul, you're with Allworth.
Hi, guys. This is Paul. I actually have two questions, if you don't mind.
Yep.
My first question is, should I pay off my mortgage? It's a 15-year mortgage. I have 3 years left on it. Right around $50,000 left to pay it off.
What's the interest rate?
4.5.
And do you have $50,000 in the bank somewhere that you could just pick up and pay it off?
Yes.
If I offered you a CD today at 4%, would you take it?
Yeah.
Okay. That's what this is.
That's all that is.
It's guaranteed. It's just on the other side. It's not guaranteed to you. It's a guaranteed interest rate. that
You
have to pay.
lent the money to someone at less than 0.5%, and you turned around to the same person and you borrowed at 4.5%.
My thought was I only have 3 years left.
Doesn't
on the
matter.
mortgage.
It's
You know,
4.5%.
It doesn't matter how long it could be.
That's
50 years. It could be 200 years. It could be 3 days.
That's $2,000 of interest you're going to be paying this year by keeping this. $2,000.
Yeah.
Yeah, paid off. Boom, done. All right. Second question.
Waste $2,000 somewhere else than here.
Yeah.
Well, I got a whole, but you can answer that quickly. Well, I got a whole bunch of them for you. Well, the other thing is I have a 457, and I was wondering if I should convert it to a Roth.
How old are you?
I'm 55.
Are you still employed?
No, we're both retired.
Okay, let's talk about this. So you asked two questions. One, should you convert it to a Roth? And the second question really should be, should I convert it to an IRA and then convert it to a Roth? The 457 has a tax code that sits around it that's different than IRAs. So when you retired, there was no penalties on taking money out of the 457.
Doesn't matter how old you are once you retire.
Regardless of, and by the way, for everyone listening, you're like, that's not right. It's right because it's a 457. It's not a 403B or a 401k.
457s are for municipalities primarily.
It's a different tax structure. So
Okay.
Because of that reason alone, you may not want to convert to an IRA or a Roth, but you may.
So you're both retired. Do you have receiving pension income?
Yes.
And how much is your pension income between the two of you?
We're before taxes like $9,000.
Okay.
And are you living off that solely without any distributions from anywhere else? And by the way, remember, you no longer have a mortgage.
Oh yeah. With the mortgage, we're fine. Yeah, we're living
And how much
fine.
do you have in 457, IRA, 401k, any other savings accounts?
It's like $400,000.
And where do you live? What state?
California.
And do you plan on staying in the state of California?
Yes. I mean, yes.
It is a pretty nice state, by the way.
I do too. I just complain.
I know.
We thought about moving. Wait, don't convert anything. Wait till I move to another state that doesn't have,
Thank you. You know exactly where we were going with this. I'd run a pro forma, but I doubt that there's much benefit in moving to a Roth IRA for you because your income's going to be pretty stable. Are you Social Security eligible at age 62, 65, 66?
We are, but it's I guess it's because we had the windfall pension.
Yeah.
They call it.
I would run the numbers. I wouldn't do anything till later in the year because there could be changes to the tax code this year.
Yeah.
That could be retroactive to earlier in the year. They've done that before, so it could happen again.
Well, and that's part of the reason why I'm thinking about converting is because I just see all this COVID stuff and all this money they're spending.
Yeah.
They're
Yep.
trying to get that money
Yep.
somewhere, and
Yep.
So-
Yep.
form of taxes.
So
So our
would do
tax
it
rates
over-
are relatively low, and the way they're set. Matter of fact, the 22%, 12% rate, which is you're right on the bubble between where it goes from 12% to 23%, 22%. That rate is scheduled to bump back up to 15% in 2025 when the tax.
So what
Rates
you'll end
expire.
up doing is you're going to run a pro forma. If you do your own taxes or have someone do it for you, they're going to actually dial those numbers in.
And you can do some
It
what
might be
ifs.
20 grand, 25
grand.
grand.
It's not gonna be
going to be a lot.
Unless you really think I'm willing to pay the tax man a bunch of money today, which I otherwise won't have to pay for 18 years before your required minimum distributions. You're that confident that that whatever rate you're at today is going to be higher.
So in saying that, how much money do you have outside of IRAs? Remember, you just used 50 grand to pay off your mortgage. How much more money is outside of
I have another
IRAs
120,000
after that? Yeah, you might.
after.
Yeah. So I'd run
Run the
the pro
numbers.
formas.
And-
I'd run. My guess is you'll end up doing a little, not a lot.
But there's some home improvements I want to do. There's always stuff that comes up that new carpeting.
Yeah.
Our pension covers our daily living and going on trips here and there, but it doesn't cover a bathroom model. So
That's
Yeah, well, that's where the extra 400 grand comes in. So you might, some of that you might be spending too.
yes. So you run the
I don't-
numbers.
that's it. I don't know when to start spending that money. I mean,
Yeah.
Well, get a financial plan done.
Right. That's
Go
easy.
talk to someone like us. Get a financial plan done.
You can tell you.
Then you'll know.
Then you'll know.
well, I guess really that's what I need to do. I need to sit with someone and get a financial plan.
Then they could go through all those scenarios you were talking about.
Yeah, and actually tell you. I mean, if you were sitting with one of our advisors, we'd tell you
That's
exactly
it,
how
right?
much you were going to
Yeah.
convert to the penny.
And here's how much you can expect. Here's how.
And
you
this is when you're going to do it. You're going to do it November, December.
I know. I thought you had to have a certain amount of money before the financial planners leave.
No, well, we have fee for service too, which is we don't manage the money. We just charge you for a financial plan. Right?
There's
You
different
come in
ways you can do
there.
it.
There's a lot of different ways you could pay. As long as you understand what you're paying, then you decide whether there's value there or not. And that's just not for our firm. That's for all good financial planning firms. So I'm not here too. Anyway,
Once my wife and I both retired, I'm like, oh my goodness, I moved all my money into safe stuff. I was kind of pretty aggressive before.
oh, see,
I wouldn't do that.
yeah.
You would be well served to have someone help manage those dollars.
Yeah, and the reason being is that you had an emotional reaction.
You've got that pension's
you're
worth a
never
couple
gonna-
million bucks.
Yeah,
Guaranteed. Couple million bucks. Guaranteed.
It's like a bond portion of your portfolio. I mean, I could make an argument. So what we would do is you take a look at that $9,000. You look at
That's
your
worth
age,
a couple million bucks.
and you do what's called a net present value calculation on this, and you realize that is worth a ton of money. and then you build your 401k.
And you learn to get more comfortable.
Appropriate.
And you learn to get more comfortable. I mean, investments a lot is based upon how much your ability to withstand some of the ups and downs. So anyway, appreciate the call, Paul. Certainly wish you well. So
Yeah, people forget how much those pensions are actually really worth. I remember
it'll afford you to take on more risk in your other areas.
Husband and wife retired from the state of California, and they came to my office and they said, well, we heard that you had to have $1 million to retire. And I said, based on these pensions here,
You've got way more than
you've got way more.
And I don't know why our state has any financial problems. It's bizarre. I don't understand.
Way more.
All right, let's continue on. 833-99-WORTH is our number. Let's talk to Mick. Mick, you're with Allworth's Money Matters.
Hi. Thank you very much for taking my call. I've been on your show before, maybe 7 or 10 years ago. But this time, I think I've reached the end of my rope, and I don't think I'm qualified anymore to do the taxes for my family or prepare for retirement. My wife and I are 64. She's an entrepreneur. She started 3 companies here in Davis, California.
Oh, I remember you.
Do you really?
Okay.
Yeah. And your company just got a new CEO.
Right. That's exactly correct. Yes.
Yep. I remember, absolutely remember you. And the last time you called, it's because you had a heavy concentration of this biotech stock.
That's what I emailed in for. Yes, exactly right. So this is her company.
By the way, listen, congrats to your wife. She is absolutely brilliant. You guys have obviously, some people are going to connect the dots. This company had a CFO that was cooking the books, and it's a publicly traded company, and it cratered. I mean, it was on the edge after that CFO was cooking the book. So what he was doing is he was actually booking sales without actually doing the sales. Short story.
It wasn't the CFO. It was a COO. I don't want to give the CFO a bad reputation.
Oh, thank you. Okay,
He's got a defamation suit.
I got half the story right. But listen, you're
and the COO's trial. He's supposed to be getting his sentence pretty soon.
Oh, good, good. And by the way,
so many times. So.
What a great. By the way, much admiration for your wife and the company you have built in the space you're building, and what the new products that you're coming out with right now are just absolutely amazing.
And for the rest of us, we have no idea what you're talking about. But anyway, how can we?
What's your question?
Because I have zero recollection of this conversation. But
well, she's an entomologist, and she creates green products to grow crops.
Got it.
And this is her third company that she did that with.
And so, what's your
we
question?
Reached the point now. Well, she's become retired, and now she has RSUs, and she's got all these alphabet soup stuff that I don't understand. And one of the biggest ones is that when she first went public, the different people told her that she had qualified small business stock that she could get at lower capital gains rates for.
Correct.
And I'm looking all over the place online, trying to figure out retirement strategy and charitable contribution strategy and stuff like that on which shares of stock do we actually sell and use to live on maybe or to diversify. The big thing is to diversify.
That's right.
This way huge percentage of her stock in our portfolio. And which ones do we just hold on to and maybe nieces and nephews will get when we die?
So
which ones do we just commit to charity and say, here,
look,
let's put it in one of those.
You're not going to get the answer on the air, but
so there's a lot of moving parts here.
So each one of those lives in its own tax world. Each one of those segments lives in its own tax world. So we have quite a bit of experience working with these qualified small business stocks. So what you do, the process you go through is you put it on a spreadsheet and you look at the tax implications of each one of those. So some of them are great for charities. Some are great for inheritance. Some you want to gift today, not in an inheritance. And some of them you're going to liquidate based on your tax rate and how they're treated. But you're not, you have to go through the process because you look at them as all the same stock. And they're not all the same stock. There are many flavors of those stocks. So you're not going to get the answer from me today because of the process that you have to go through. But
if you see a good financial advisor, particularly one that has a tax firm within it, then you get the team could work together.
And it's not hard. I mean, it isn't hard. It just takes a little bit of work for you telling us the history and how they're actually titled. And
they called like 6 different companies, and 3 of them told me they think that the Trump tax cuts supersede this, so this doesn't exist anymore, which kind of made me a little depressed. The QSBS. And then others said, "Well, I heard about that somewhere. I'd have to research."
Well, look, that's none of those are answers, right? None of those.
Right.
That's just that's just someone.
Like reaction.
Yeah, it's someone just they're speculating.
Which is what we could do on the. Hey,
I
we're
could
not
do that
going
if you
to.
want.
Right,
I could tell you what I think, but the reality is, I don't have enough information from you to actually give you an answer. So.
You would be,
but this is a great opportunity.
Yeah, and
I think I need to use a pro for the first time in my life.
I think you do.
You
know what's interesting?
TurboTax and Google just isn't enough anymore.
Look, you're on a different level here. There is nothing TurboTax or Google's going to answer for you. Nothing.
Okay.
It's going to give you something, but you're going to have to actually. Put it in a spreadsheet and actually look. Part of a co-CEO of a firm that manages almost $11 billion. I understand it. You know who manages my money? My own firm, not me.
Oh, your own firm. Okay.
Oh, I was going to say, we're going to learn something new.
No, my own firm. Right, my wife's an accountant. Okay. You know who does our taxes? An accountant, not my wife. No, not her.
Okay.
Right?
Yeah.
And you're in that situation. Yeah. You're not in the minor leagues anymore, Mark. You are not in the minor leagues. You have to actually do an analysis on this. And you're going to pay someone for their advice.
Yep. It'll be money well spent.
Just accumulating our retirement over many years.
Vanguard did a study. Morningstar did a study. Both showed that good quality advice will pay for itself. It won't cost. And particularly the more complex, you get quality advice will more than pay for itself.
Anyway, so I'm so glad you called. I remember the last call. I track your wife's success, and it's darn impressive. It's really, actually like to meet her someday because she sounds brilliant. And you sound like a nice enough guy, too.
So call us in another 6 or 7 years, Mick. That was.
I called you Mark. Mick. Okay, thanks, Mick.
Okay.
Yeah, appreciate it. Hey, at the beginning of the program, we said we wanted to spend a little time talking about these SPACs. And this is the most amazing thing. Actually, we say that every week because it's just a bizarre time in a lot of the financial world. It's a way for a company to go public without having to go through all the regulated hassle of typically going public.
It's crazy.
Oh, it's stupid, right?
And they don't even tell you what they're going to do with the money.
So what these are special purpose acquisition companies, and it's where they'll float a new company that says, well, we don't know what we're going to do with it yet.
We're just going to raise money, and after you give us the money, we're going to tell you how we're going to...
And we have to find an investment within, 2 years typically, or we have to give your money back.
And, by the way, I'm going to set up a compensation plan for myself as the CEO that greatly enriches me regardless of whether there's a return on the money or not.
Yeah, maybe 20%.
Unbelievable.
Of the value of the company.
Unbelievable. There's people in the financial services industry that have left corporate jobs that are setting these things up.
Oh.
and they and they raise $100 million and their net worth goes up by $20 million the next day.
Shaquille O'Neal did one. Richard Branson did one.
This is brilliant.
Though. I'm not saying anything negative about those individuals, by the way.
Scott, you've got to admire them. You have to admire them.
But the question is, how are they doing for investors?
They raise the money.
Billions and billions of dollars are getting transferred this way.
So, just as a Reader's Digest version.
And there's been more issued this year than there were last year.
I start a company.
All of last year. It's crazy.
I go public with a stock. You buy the stock. We raise $500 million. I don't tell you what I'm actually going to do with the $500 million.
So this was from an article out of Wealth Management magazine, which is an industry periodical. And it looked at the performance of these special acquisition companies by sector. These are the various sectors. So unspecified, which was the largest sector, the 29 deals, like we don't even know what industry we're going to invest in. Give us your money.
Great.
Down 21%.
Which one was that? That was
Unspecified.
Oh.
Consumer discretionary. Down 15%.
In the last 12 months.
Financials. Down 10%.
In the last 12 months.
Since they went public.
Oh.
Now, on the other side, there's been 3 deals in communication services, up 114%. There's been 7 deals in healthcare, up 42%. Technology's had 14 deals, up 10%. But on average, the average return has been a minus 9.6%.
This, Scott.
So why are these questions why are these products popular?
Because it's a GameStop.
Even
it's a
former
Bitcoin.
House, Paul Ryan set one up.
Did he really?
Yeah. Billy Bean of Moneyball, he set one up. Astronaut Scott Kelly.
Look at these guys.
This is a transfer from middle-class savers to these founders of these things. Typically, 20% of the value of the company goes to the founders.
Would you buy one?
Heck no. I almost swore. Heck no.
Right? It's crazy. Listen, I am impressed every day by how Wall Street has the ability to extract money
when
from
the ducks
hardworking
quack,
people.
feed them, is the saying on Wall Street, which is why why our structure is designed to represent our clients.
Not Wall Street.
Our revenue comes from our clients, not from Wall Street, not from products.
Remember Wall Street. When the ducks quack, you feed them.
Not good. Anyway, unfortunately, we're out of time. It's been good being with you. Hey, we got an article on our website that you might enjoy. 8 important reminders as tax season begins. That's at allworthfinancial.com. It's been great being with you. We'll see you next week. This has been Scott Hansen and Pat McClain of Allworth Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.